Hey traders, Nick Shaheen here looking at what does an iron condor mean? You've heard it, it's often referred to in the media, or you've read about it or on Twitter, and you're like, what is this thing? Plain simple English, quick explanation, even if I don't know options. So the options market, first of all, are basically contracts, call them bets, over the price action. And there are some bullish ones and some bearish ones. So those who want to bet up and those who want to bet down, they can do it through the options. They were initially created eons ago to the contracts, so-called contracts, to hedge bets. So if somebody's buying futures, if somebody's buying a commodity of sorts and they wanted to hedge their bet, they used options, futures, contracts, and this is basically the same thing. So in this case, I could bet up by buying something up here, calls. They're called call options or call spreads. I can bet down. It's called buying a put or a put spread, kind of like protection in case something falls. We're looking at the SPY 30-minute candles. So what the heck is an iron condor? It's basically betting both ways, against both ways. So I'm betting that it's not going to go through the moon. I'm betting it's not going to go through the bottom. And how can I make money doing that? So for example, for this week, today is 12/10, 2019. This is where the SPY was sometime this morning, and then we're going up and down, headline, no headline, blah, blah, blah. So if I wanted to range bound the rest of the week, which are 3 days left or so, I can sell the upside, uber optimistic scenario. I can sell the downside disaster scenario and wait. If I'm right and price stays inside this box in the next 3 days, both of these bets, the people that bought them will lose. So I basically sold them 2 losing lottery tickets and I would win on both ends. So that's called an iron condor, when I sell risk on top and sell risk on the bottom to range bound the trade. So if I have visibility and I have confidence in my levels and say, okay, there's a gap down here, I'm going to consider that. And there's whatever there was back here, and there should be some resistance up there, and I've got 3 days to wait this out. I think I'll take a risk up here. I think I'll take a risk down here and see if both of these people will lose. So how can I lose? I lose when prices go this way beyond what I collect for both bets, or that way beyond what I collect for both bets. I can't lose on both sides. So if I take one side or the other, I have, let's say it's a $1 wide spread, I would have slightly less than $1 worth of risk. But if I take both sides, I can only lose on one side, so then I reduce my money at risk. This is kind of a little getting in the weeds, but the concept is it's a self-hedged bet. So I can take a little heat this way, I can take a little heat that way, better than taking one side or the other. This is not always easy to do, because especially in headline trading, because you get a headline, boom, you get blown out, as we just seen overnight. But if I have good visibility on levels, it's a pretty darn good way to do it during headline period, as long as I'm good with my stops and with my level picking. I can make this smaller of a region and collect more, but then I reduce my odds of success. By going out wide, I increase my odds of success and I give back some money. Okay, I don't want to make $1 billion. I want to make a little bit less than $1 billion. Exaggerating, of course. But again, the point is, what's an iron condor? It's basically a range-bound trade where I have visibility on the range for the next X number of days. This could be a few days, it could be a year in advance. I've done them a year in advance. Those are easy. But I have to do homework first and figure out the range that I believe in. In this case, it's short term. It's a little bit easier than looking out in the future. And I know right away whether I'm right or wrong. So I sell both sides and I wait for time to tick, and they get cheaper to buy, and I can close them before the time expires if I want to not deal with it on Friday. This is the SPY example. It's not a trade recommendation. It just happens to be a real life width that I will probably pick, depending on the portfolio. Nick signing out.